Hello, everyone. Hope you're all doing great. We got a lot to cover in today's video, and it's very interesting to see the market continuing to rise higher and higher every single day. It's almost as if there's a magical magician behind the curtains doing some kind of magic trick, lifting the market higher and higher. In today's video, I'm going to talk about the global central banks that might just be propping up the stock market. So please let me explain while I dive right into the video. As you all are aware, during the Christmas Eve time, December 24th, the market really bottomed out at a very horrific low of around 2,350 for the S&P 500. Ever since Christmas Eve, the market has rallied essentially every single day. It's been green. The market has since recovered about 13% to where we are currently sitting at almost 2.7 thousand. Now, something really important to bear in mind is that we did break through the key 50-day moving average. So we'll actually end up seeing what happened. We actually might hit the 200-day moving average, but let's see what happens. Now, look, some of you are big Netflix fans. You might have watched the movie Bird Box, and there's a lot of interesting things happening, and you need to see for your own eyes. Regardless if you're a bear or a bull, you need to see the truth. And the truth is that central banks are probably the ones behind what is happening to the market rally. Recently, Donald Trump tweeted out just this past weekend. He was saying how, he's always talking about the economy and the low unemployment. Like, I get that. But he's also saying how the stock market is again ready to break another record set by us many times. The word us was very particularly interesting to me. Us made me think about global central banks, which is the key theme of today's video. Now, here's a great Twitter post by this guy on Twitter, and he's talking about who's pumping the stock market. Well, I'll tell you what, it's currently not the Federal Reserve here in the U.S. This is showing you the central bank's balance sheets of China, European Central Bank, the Bank of Japan, and also the Federal Reserve. As you can see, at the Federal Reserve, they are continuing to taper off their balance sheet by rolling off bonds that are maturing. Now, what you really see here, I want to point your attention to, is really this December 2018, January 2019, Bank of Japan and the Bank of China is really the ones who are pushing the market higher by continuing to do more quantitative easing. This is more separately, so let me show you a chart of where, from a global money supply, how we look. Now, the stock market, let's be honest, is purely driven by liquidity. Now, the more that these central banks are continuing to have easy money, which means they're essentially printing money out to buy bonds, to continue propping up the market, then that will lead to a higher stock market in theory. And we are currently seeing that. As you might know, the liquidity drain that led to the sell-off in 2018, when the Federal Reserve and the European Central Bank are both undergoing quantitative tightening, that has led to more the downside. But just very recently, Bank of Japan and China, they've injected much more liquidity into the system, and that's why we're seeing the stock market rally. This chart here shows you in the yellow line how S&P is recovering because you can see the global money supply, the white line, is now ticking back up. Not healthy at all. Here's also a much more dived in, closer look of what is happening, right? The green line here is showing the global central bank balance sheet. It's been going down, but the global stock prices it remained it was going up a little bit, but then it does take a while for the effect of the central bank balance sheet runoff to actually take effect in the stock market. And we actually saw absolutely just that in late September and in October, where the global stock market just fell. Now, very recently, around here in December and also in January 2019, this is when the global central bank balance sheet started to tick back up. And look what happens. What a huge coincidence, right, you guys? Global stocks ticking back up. Now, specifically on China, right? Like China, just this past Wednesday, China said that they injected a record amount of money to stimulate the economy. To be specific, they injected about $83 billion into the banking system. And what this now means is that the reason why they did that was because they claim it was a peak season in the tax period and people will be needing to borrow money to pay off the taxes that they owe the government. And as a result of pulling money out of the banking system, that would then cause a drain in liquidity in the economy. Now, that's what they're saying. And that's why they decided to inject much more money into the economy. Additionally, another article earlier in January was China talked about how they're going to be cutting the bank's reserve ratio to boost liquidity by a total of 1%. Now, this is going to take part in two phases. 50 basis points will be occurring on January 15th, and the other 50 basis point reduction will be occurring on January 25th. In total, the cut should be releasing an additional almost $120 billion of liquidity into the economy. And what is important about this is that, this is going to be marking the fifth time in really 2008 where China has been cutting their reserve requirements. And part of this is definitely due to the sharp economic slowdown we're seeing in China. And as you can see here, this graph here shows you where the reserve ratio for big banks in China, it was almost at 20%, but it's been falling all the way down to currently at 14.5% for large institutions. Very, very low. And the reason why it's low is because these reserve ratios, if I deposit $100 into the bank, these big banks are only required to keep 14.5% of my $100, and they can loan out, the remaining amount to anyone else who wants to borrow. So by having a lower reserve ratio, there's much more money flowing into the economy. The banks don't need to essentially hold that cash in their bank. As far as the Bank of Japan go, Central Bank of Japan, their balance sheet, oh my God, look at this terrible, ugly graph just showing the spike up in the central bank's balance sheet. I mean, it's just been going up. The quantitative easing that Japan's doing is ridiculous. The past years, the Bank of Japan, this whole quantitative easing policy, where they have about in US dollars, this is about $5 trillion of assets that the Bank of Japan holds. And this is much more than the combined GDP of 5 emerging markets like Turkey, Argentina, South Africa, India, and Indonesia. This is very hard to look at. So really overall, like the recent stock market rally we've been seeing where the market is just green, it's almost as if it's printing free money. That's a great thing, if you hold stocks. But I just want to warn everyone that please look behind the curtain. Global central banks are the ones who are behind the propping up of the stock market. So just wanted to give you guys that information. So please, if you enjoyed this video, please drop a like. Feel free to comment. Feel free to subscribe. I'll gladly respond to any comments below. And I love learning from you guys. I love learning about the stock market as well. So please feel free to interact if there's anything you want me to discuss. Thank you again for watching the video, and I hope you all have a great week. Enjoy your day off tomorrow for Martin Luther King Day. And thank you all again for watching the video. Until next time, see ya.